Hello friends, how are you doing out there? This is Vijay Vambani and I'm a trader with 35 years of experience in the markets, 28 of which are as a founder and promoter of an incorporated company that trades for a living. Now in this video, I want to explain to you a very interesting concept in trading which I call vertical trading. Now, as the dictionary meaning of the word vertical goes, you're basically starting from ground up and going skywards, which is upwards. Horizontal, on the other hand, is linear or sideways. Vertical is upwards. Now, the basic tenet of vertical trading is that you trade as many times as possible. Maybe it could be even once a day if there is no clear setup warranting a second trade. Then what you do is you trade as many times as you can, taking small profits and building a small set of profits on top of each other so as to arrive at a respectable figure at the end of the day. Why do we take smaller profits? The reason being that statistically speaking, and because I deploy statistical trading systems, my in-house statistical trading model, which I've affectionately called the Barracuda, what we have done is that we've seen the longer you keep the trade open, the more is the possibility of volatility, adverse news, man-made or acts of God coming in and going against the direction, the prices being sent against the direction of where we would ideally want them to be. What I mean is that there are some spanners in the works, something comes to upset our apple cart and the result is a loss. So the shorter is the time frame, the higher is the probability that you will succeed, because a constant flow of news cannot really interfere with the price. Of course, there are times when sudden unexpected news of an earthquake or a war or whatever can occur, but those probabilities, statistically speaking, are very small. So when you take small trades and build profits on top of each other going up vertically, that is what I call the vertical trading system. There is another aspect to the vertical trading system, though it is on its final legs. Now, this is a concept which I call stacking. All right. Currently, SEBI has implemented the second stage of peak margin norms, which came into effect last year. They capped the number of times intraday limits would be given to traders in the first phase to 4x, which means 4 times. You give one lot's margin money to the broker. He would allow you a maximum of 4 lots, provided you would square up your transaction at the end of the day. In the second phase, which commenced from 1st of March, that leverage or intraday limit has come down to 2x, which is twice. So you give money for 1 lot, you will be able to take positions of 2 lots. Here again, you will have to square up compulsorily at the end of the day before the trading session ends. As on 1st of January, this leverage will be further cut down to 1.33 times, which means you give margin money for 10 lots, you will be able to take only 13 lots. And from 1st of September, it will become 1:1, which means you will be able to trade only as much as you can pay for. So, which is why I said the second leg of the vertical trade is actually a dying phase, because SEBI will not allow this phase to last beyond 1st of September 2021. So here what professional traders would do is, since they are anyway going to take positions intraday, and I many a times take micro trend trades or micro scalp trades, where the outer limit is 59 minutes and 59 seconds. Even if the price has not hit a stop loss or it has not yet reached the price target, I would exit because the discipline of the clock, which is maximum of 60 minutes, will have to be respected. So you get out of such trades, irrespective of the amount of profit. So you could take small profits and do this multiple times a day, and you could, for an intraday basis, use the intraday margin provided by the broker to stack your trades, even though you have not paid for all the lots that you're trading, which is why we call this vertical trading system. Now, I have also received a few queries from fairly excited, curious and interested people who've watched the summit, and I'm going to endeavor to answer these queries as far as possible. The first concern that many viewers have had, and I'm completely with you, I can completely understand why. As to why the transactions that I have shown have such narrow profit margins. Sometimes it is in a few paise, and in many cases it could be less than a rupee per share. There is a reason. As I've mentioned in the video itself, these are proprietary trades or prop trades. These are trades that I have entered in the computer on my own, and the kill switch, which means the ability to reverse the transaction or close the transaction, lies solely with me, and I can exercise it in the snap of a nanosecond. Such a trade cannot be recommended because by the time the recommendation goes out either via email or SMS alert or any other mobile app or whatever is the system of delivery, it is too late. So obviously these are trades that are, and these are real world trades, they were executed. These are trades where I am demonstrating that this system can be implemented. In the real world, slower trades will be given where you will get ample time to initiate a trade and then also exit the trade, which means ingress and egress, entry and exit, both will be possible. Secondly, the reason why the profit seems small is, like I said, you take small amounts of money and build on top of it. Now, since these were prop trades, we trade on small margins, and not all trades are profitable in nature. So at the end of the day, it might appear from the P&L account that I have traded say 10,000 shares or 20,000 shares. In some shares, in 1,000, 2,000, 3,000 shares, I might have even lost money. So in the remaining shares, the average purchase price and the average selling price will look like wafer thin, because not all trades will go in a profit, which is why the quantity will appear large, say 15, 20, 25,000 shares traded, and naturally 15, 20, 25,000 bought, 15, 20, 25,000 sold, and out of which say 3 to 5 or maybe even 8,000 sold at a loss. The profit per share will look like it's small, but believe me, these are vertical trades stacking on top of each other. Somebody even asked me in the query as to whether these are currency trades or equity trades. These are definitely equity trades. Although they look like they are very small in terms of percentage profit per share, I repeat again, these were prop trades. For me, this is how I trade. These are not the kind of wafer thin trades that I would be putting out. The third thing is the element of time. You can take these vertical trades and trade multiple times a day when you are firm in the back of your mind that majority of your trades will be squared up by the end of the trading session. There is no greater comfort for an intraday trader. Please understand, I'm deliberately using the word intraday trader. There are swing traders, there are delivery-based investors. I'm not addressing those. I'm purely talking of intraday traders. They would like to go flat out. Going flat out means flatlining. Just as a ECG in a hospital, when it goes flat, it tells you that the patient has expired. So your trading book has to go flat out at the end of the day. There must be neither a short sell nor a long purchase order pending at the end of the day. Everything must be squared up. So what we are doing is, we are leveraging on the fact that we, as it is, know we are going to square up the transaction at the end of the day. So why not take multiple transactions in the trading session? And even though the share might move a rupee, 2 rupee or 3 rupees only, we could try and get as much juice out of it as we can by vertically trading on it a few times, and thereby getting a higher return as compared to simply buying, say, 1,000 shares and waiting for only a rupee by the end of the day to get only 1,000. If the same thing is repeated a couple of times, chances are, and here we are playing with probabilities, not guarantees, chances are that you might wind up with a higher profit than simply vanilla system of buying, holding and squaring up by 3:30. I'm open to the idea of answering any questions that you might have, and please contact the customer support team. I'll be more than happy to address your issues. On this cheerful note, I bid goodbye to you in this video, not before reminding you to click like on this video if you agree with what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon and receive alerts about fresh videos being put up here. In the comment section, keep the lines of communication open. Positive, negative, love, hate, any feedback is welcome. And if you like what you saw in this video, help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. I wish you have a very, very profitable day ahead, my friends. Thank you for watching my video. Take care. Bye-bye. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.